I'm about to show you something that happens over 100 times a day on your chart, and you've probably been ignoring it. It's not an indicator, it's not some secret strategy. It's a gap in price action that forms during fast moves. And once you learn to spot these gaps, you'll know exactly where price is likely to return before it even gets there. And stick around to the end because I'm going to reveal the single biggest mistake I see traders make when trading what are popularly known as fair value gaps, or FVG. And it has nothing to do with identifying the gap, it's how long they wait. But first, let's break down what these gaps actually are. All right, so what exactly is a fair value gap? Let's take the common jargon out because these are actually very old patterns. Japanese candlestick traders, you'll see this often with a fast moving 3 black crows or 3 white soldiers pattern. Japanese candlesticks date back to the 1800s. More recently, Linda Raghee, a well-known and successful trader interviewed in the New Market Wizards, calls them cave fills, seen on market profile charts indicating a fast, imbalanced move with no agreement or fair value established. These often act as a magnet for price to revisit later for repair, functioning as strong support and resistance. Regardless of what anyone prefers to call it, it's a blank zone left on the chart when price rushes through an area so fast that buyers and sellers didn't trade there, like an unpainted streak on a wall. These empty zones matter because the market hates inefficiency. Just like you'd go back to fix the streak on the wall, even if you didn't feel like it, price usually comes back to fill these gaps. What goes too far too fast must return to rebalance. There are two types. A bullish pattern. Price shoots upward aggressively, leaving a gap underneath. When price eventually retraces lower into that zone, it's common to see buyers step back in and push it up again. A bearish pattern. Price dumps hard, leaving a gap above. And when it pops back up into that zone, sellers often smack it right back down. The beauty of knowing this is that you stop guessing on direction. Instead, you're identifying zones where the market has unfinished business, places it must revisit to rebalance. It's like the market ran out the door too fast and realized it forgot its keys and has no choice but to come back. And here's the kicker. These aren't caused by news or overnight moves. They form during the live sessions because of one very specific force. One thing that all traders can agree with is that these patterns form because of one thing: institutions. They form when banks, hedge funds, and algo systems shove massive orders into the market. These players don't just tap buy lightly. They bulldoze through the order book with so much volume that the market literally cannot keep up. This is because there isn't enough liquidity to match those giant orders evenly, resulting in price jumps, leaving those empty zones where almost no transactions occurred. Did you guess what that empty space is? You guessed it. That's your fair value gap, or what I like to call IFAs, institutional footprints of aggression. But here's the thing. Institutions know they created that gap, and their algos are programmed to use that retracement to rebalance, fill those leftover orders, and clean up the mess that they made. So when price comes back into the gap, they step in again. This is just institutional housekeeping at its core. Now, how can you spot the best fair value gaps? Because if you didn't know, fair value gaps pop up everywhere, but most of them are noise. The ones that truly matter are the ones that formed after a liquidity sweep. Those are high conviction, high probability institution-backed setups. Here's what they look like in real life. Think back to the Tesla squeeze in early 2023. Price was grinding just under $120, tapping that level multiple times. Then one morning, boom, price spiked to $121.50, grabbed all those stops sitting above 120, and then immediately reversed lower, ripping down to 112 within hours, leaving behind a massive gap. That wasn't random. Institutions swept the liquidity above 120, think of it as fuel in the tank, and then fired off the aggressive move that created the gap. That gap became defended support for weeks. A liquidity sweep is when institutions need fuel before making a big move. They run stops sitting above highs or below lows, grab that liquidity, and then they fire off an aggressive move that creates the gap. If you see a fair value gap right after a stop run, and stop runs are just order fills, that's institutions basically saying, okay, now we're ready. Now, most new traders see gaps everywhere, but they can't tell the difference between a real institutional setup and random noise. They enter too early, they get stopped out, and then they think fair value gaps don't work. That's exactly why I teach my mentorees to separate high conviction fair value gaps from the trash fair value gaps during my live trading sessions. Because once you know what to ignore, the winners become obvious. I'll drop more details at the end if you want that kind of precision trading in a live trading environment. But right now, let me show you how to actually spot these gaps on your chart in real time without missing them. It's a lot easier than you think. You need just 3 candles. You're looking for a simple 3-candle pattern. The first candle is the setup. The second candle is the aggressive impulse by the institutions. And the third candle, that's the confirmation. But before I get into it, here's the only rule you need to remember. The wick of candle 1 and the wick of candle 3 cannot touch. If there's space between them, you've got a real fair value gap. For a bullish FVG, you draw a box from the high of candle 1's wick up to the low of candle 3's wick. That is your imbalance zone. For a bearish FVG, it's the opposite. You draw from the low of candle 1's wick to the high of candle 3's wick. That box you just drew is your imbalance zone, or the magnet price will usually return to. Now, if the wicks overlap even slightly, discard it. That is not a true fair value gap. That means there was enough liquidity during the move and the market already balanced itself. No imbalance, no gap, that means no magnet. The best part is you can do this manually in about 3 seconds once you train your eye. Or if you want to feel like Iron Man, you can use an indicator that auto shades them on TradingView or MT5. Remember, any true process can be coded, and that's why I code all my indicators. Either way, once you start making these, you will see them everywhere. They show up dozens of times a day on every single time frame. Quick note, most traders can identify fair value gaps, draw the boxes, and see the gaps. Then they freeze. They don't know which ones to actually trade. They don't know if this specific setup is worth risking money on. If that's the kind of edge you need, everything to join me in my live trading community is linked on my website. But let's keep going, because identifying the gap is only half the battle. Now I'm going to show you how to actually trade it. So can you actually trade a fair value gap? Let me show you. First, you take the entry, and there are 2 options. The conservative entry. You wait for price to fill the entire gap, and you entry at the boundary closest to the original move. It's safer, but your risk reward won't be as attractive. The aggressive entry is when you enter at the 50% midpoint of the gap. This is the equilibrium. And the institutional algorithms love this level because it's where they efficiently complete their orders. Your risk reward ratio here can be phenomenal, but you need to use smaller size because you're going to be using a very precise level. Second, you place the stop loss. This is really simple. You place your stop just beyond the far edge of the fair value gap. If price closes past that level, the imbalance is invalidated and you're out. No debates. Third, you take profits. Your target is either the next structural high or low, think support or resistance, or the next opposing fair value gap. This is because that's the next magnet in line. That's the next imbalance. The price moves from imbalance to imbalance like it's hopping between lily pads. Finally, some quick advice. If the gap isn't tested fast, forget about it. This means that if price doesn't revisit the gap within 4 to 6 candles on that time frame, skip the trade completely. Institutional urgency has disappeared and they found liquidity somewhere else. It's like waiting for someone who said, I'm on my way, and they never left the house. Now remember, at the start I said I'd reveal the biggest mistake. Well, here it is. Traders wait too long. If the gap isn't tested within 4 to 6 candles on that time frame, it means that institutional urgency has disappeared. But most traders sit there waiting, hoping, praying price comes back. It usually won't. Move on. That's the difference between disciplined traders and bag holders. Now you know the difference between traders who make consistent money and those who keep blowing out their accounts. Well, it comes down to one thing: understanding where institutions are actually operating. Remember, that's size. I've packed everything you need to build that skill set into the resources below in my trading community. And if you're ready to accelerate your progress with direct mentoring from me in a live trading environment where I personally show you how to filter setups, manage risk, and trade with the kind of precision that turns fair value gaps into actual setups week after week, check out the links below. I won't tell you to imagine it. You'll actually be looking at charts and instantly identifying the high probability setups with me. That's the edge that we're building together.